Welcome everyone to the fifth episode of the Futurum Equities podcast. You got myself, Shay, Boloor, aka Stocks Savvy Shay. We got Newman in a tropical environment now. It's no breaks. We can't take a week off. We got to keep going. Dano, how's life treating you? I
I'm
know
in the
you've had a
bunker.
week.
I'm in an undisclosed location, but there have been breadcrumbs. If you've followed my Twitter, my X, I've been sharing little bits of the magic of where I am. But it's like one of those places that it's so good, I don't want to share it with anybody. Nobody's allowed to know because it would ruin it for me. It's like I'm in this spot. There's not a lot of people, not a lot of population. Despite the online persona that I portray, I really like to be much left alone. It wasn't that much of a vacation for me, to be honest. I ended up working a lot. Anybody that's sort of been following I think I did 2 or 3 television segments. I presented to the entire global leadership team at ServiceNow. I did a fireside chat with their CFO. I've been on meetings all morning. I did my other pod, the 6-5 today. But I feel stressed when I'm not working. Like I feel stressed when we're not doing and building. So you and I moved the ball on a pretty big thing that we can't share with everyone yet about what Futurum Equities is up to. But we're doing something big. But the one thing I didn't do is relax. I like every morning I'd worked out for like 2 hours. And then what I would do is like I'd go grab breakfast and I'd like stand in the ocean for about half an hour and just soak in vitamin D. And then I'd go get on my calls. So terrible vacation taker, but I feel more content, Shy, when I'm not sitting around. I just don't know how to sit still.
No, I mean, I follow that same sentiment. I get antsy. My fiance is worried about our 2.5-week honeymoon. How much I have to work. I love it. I feel like if I take a couple of days off, I substantially lose my edge and have to play catch up. And I hate that. I hate the feeling of playing catch up. So I totally get that sentiment. Going off of, you did a little work, little crumble. You bought some Oscar this week. You want yeah, it's one I am almost, it's almost up at the level I want to get into it, $13. And I think like Oscar is really interesting right now for me specifically because the way they're trying to tackle insurance is very different. It's very disruptive. It's again, the phrase I like to use is they're a rational player in an irrational industry. Like they are actually trying to like reroute what it's like for a member to go to stop going to an expensive ER and actually steer those members towards like the urgent cares or to lower complication providers. Having claims deflation is a real thing in the healthcare space. And if there is a company who can like disrupt that, their value will be sky high. I use the term the stripe of the insurance infrastructure if they can actually solve that, because a lot of insurance companies will be built on top of what they're trying to actually tackle. And if they succeed, watch out. But as of right now, the market's not believing they're going to succeed.
Is it that though? Is that what it really is, or is it market makers? Is it accumulation? You know, we do know with pharma stocks, we know with healthcare stocks. We also know with sometimes small cap stocks. You know, I always say like the dumb money gets pushed out because you know, a trend line of a bunch of red candles, like the 20-13 run, all the momentum people that got in, they got fucking squeezed out. And now they lose their shares and institutions buy big. And then because the institutions are patient, they're willing to wait a year. They're okay to come in at 13. I mean, you know, I saw this play with SoFi. You know, SoFi was 28 coming out of the SPAC, went all the way down to $4. Okay. They got downgraded, even as their revenue grew, their earnings grew, their membership grew, downgrade after downgrade. Every time the stock would get a little bit of momentum, it would go back down 30, it would retrace 40%. And then a bunch of retail would give up, they'd get out, and look at where all the buying happened during that time. It was all institutions accumulating larger and larger positions. This is the same story with Robinhood. By the way, this happened with Palantir. And if you go back into history, this happened with Amazon. There was a decade of accumulation of Amazon before Amazon was really allowed to do what Amazon is doing. Bitcoin, there were so many people. I mean, I put a post out this week about, you know, how many times did Larry Fink, BlackRock, one of the biggest institutions on the planet that drives so much stock and valuation appreciation in anything they invest in, how long did they basically call Bitcoin everything from a money laundering scheme to a zero value to we'll never make this available to our customers? And now their largest position is a BTC ETF fund that they built. So, the bottom line is that, you either believe or you don't. You either have conviction or you don't, and you either understand a business or you don't. This one to me is a little bit more of a, hey, one, the company's in really good financial shape. It's got, I think, something like $11 per share of cash. So first thing I always look at, like, if a company has a vision, do they have the cash and the runway? Because they are trying to disrupt an industry that is very, very mature. The second is, are they tech powered? And what I understand about it, and again, is they have a full stack AI platform. It's an end to end, kind of like what people have gotten excited about Lemonade and other, Tempest, these other companies. They're trying to put AI, and not just an AI facade. They're seeing 2 million members, 41% growth in that area. The revenue surged 42%. It's like, look, there's a lot of bears out there, a lot of people that say this isn't a great investment. I don't necessarily see this one being like a 13 to 100, like a Robinhood run, but I see a very realistic 13 to 30 coming up for this company, just based on fundamentals. And one other thing I'll say is, everything else is frothy. Healthcare is not. Healthcare right now is not frothy. So if you're sort of like one of those people that's looking at everything and going, wow, all this tech could pull back, all the fintech could pull back, all the crypto could pull back, where's a position I could be in that could actually do well if the market reversed? Healthcare will do well when everything else doesn't. So it's not a bad place to be also if you are starting to think everything's a little frothy.
That's actually a really interesting mentality. It was like a pair trade almost, because everything is. We'll get into the frothy industries in a little, but I want to stick on Oscar because healthcare is a great yin to the yang type of mentality where I have capital. I don't feel comfortable investing in the other conviction plays I have because they've all ran on a multiple expansion. Where else can I allocate some capital in a conviction play? Oscar makes sense because, again, if you guys don't know about the healthcare space industry, it's very slow moving. So if you think that this is going to be a massive mover like a Palantir, Robinhood, Rock Lab, ASTS, etc., has been the past year or two, that's where you might be offsides because I think it's going to be a compounder, but the red tape bureaucracy will anchor the stock a bit. And you're seeing some noise about that right now, especially on all the downgrades that the analysts are showing in this past couple weeks. It's kind of odd. It's like it doesn't pass the sniff test of how much it's compounding these downgrades. But either way, I do think that as someone who's worked in the industry for a while before I finally got away from that the shackles of healthcare. Like healthcare insurance companies, like they do just pay your bills after you get the care. And what Oscar is trying to do is just change where you go before anything happens. So it steers you towards the urgent care over the ER. And people think, oh, how much of a dollar saving is that? Like it's 10x. Like I think people don't realize an urgent care is probably a couple $100. ER is a couple $1,000. That's a massive difference.
By the way, you love like a good analogy, Shay. So I'm going to say Oscar is the SoFi of healthcare. Ooh. It literally has all the same headwinds. It's got, you got people pushing it's a regulatory issue. You got people pushing back that, they can't break through. The industry is too established. There's too much, the regulation is too complicated, that there's not really a space for a new entrant. The only difference is the analysts, unlike the banks that are analyzing the neobanks, which has always been pretty ridiculous to me. Like, okay, JP Morgan downgrades SoFi. It's like, of course, Bank of America is not going to be a fan of the companies that are, unless their investment bank position is good. So anyways, I mean, I'm just saying like there is a lot of that kind of alignment here that this is the neo disruptive company that's trying to make an impact in an industry that's very mature, that has a very sort of consistent processes, and there's going to be some pain as you try to disrupt. It's not going to be smooth sailing. But if you're long, like if you're trading, I don't know, but like if you're long, especially at this point, like at 13 something, I don't know. It seems like even Shay might want to get in on this one.
Yeah, it's getting towards the level I want to, and I have a lot of cash, and where else am I going to allocate that cash? Like I don't want 4% risk-free rate. Like I'm not that schmucky. Like I want some
young, man.
alpha.
That's
yeah,
not,
I
know they say inflation. They say inflation's 2.7, Shay, but it's not. It's you need to be making more than 4% a year.
No, I agree. And going back on what you just mentioned on like SoFi, I also want to talk about Robinhood. It crossed $100 billion today.
Insane.
That's nuts. People again thought this was just a brokerage just a year ago. I was part of the camp where like I didn't know how to price them. Like, are they a tech company? Are they a media company? Are they a brokerage? And because it was so noisy, I didn't listen to Daniel's advice when he was telling me, dude, this is going to be a big one. Degenerates, the degenerates theme is very real and it's only going to compound. Clearly, I was in the wrong. But what's your take, Daniel? Because I know you doubled down on the tariff dip in the markets, and now you're looking pretty nice on
Yeah,
your Robinhood
yeah.
position.
It was a total YOLO. I mean, so the backstory though is that I won't disclose exact positions. I'm a little bit more of a private guy than you about this stuff, but I have a very large SoFi position. Okay, a lot of shares, and there was a point where I thought about taking half my shares and saying I'll sell half my SoFi and buy Robinhood because they were about the same price. There was a point when like not that long ago when Robinhood and SoFi, one was like 17 when SoFi was 11, Robinhood was like 17. So let's just say I would have probably been up more than 6-7 million on that trade had I actually gotten in instead of just being a purist SoFi bull. So while I am enjoying the moment, I will be the first to raise my hand and call out my losses. And that was a pretty big loss that I didn't go bigger. But, you know, it was one of those situations where it came back, it kind of ran to like 70 or 80, and then it came back into like the 30s. And I was
Oh my
like,
God, it's tripled.
this,
I can't.
the,
It's
yeah, I
crazy.
was like, but like, I'm like first of all, you know, the volatility on this one's incredible, but the momentum is even more incredible. It's constant innovation, and it has something that I've just found as an ingredient for running stocks, and that's a CEO that's willing to get out there, make big claims, take big risks, and innovate quickly. You know, Vlad is, you know, he does what I wish sometimes Noto would do. I know their style is a little different, but you know, he gets out there and gets out in front of their innovation, and he just, you know, he's absolutely relentless about pushing the innovation of that company. So you know, always be disrupting, right? ABCD, always be changing, always be disrupting, and so Vlad is all over that.
Let's talk about something else that's just disrupting every secular shift, every shift in every industry in the world, and that's AI. And we
Ooh.
had our top dog in the Futurum AI 15 list report their earnings this morning. And although the stock price might not reflect the sentiment, but they proved why they belong in the top spot. What was your takeaway in that print? Because I came away bullish, even though the stock price didn't reflect it. I came away saying like, all right, they've proved that the AI demand is still far exceeding all expectations right now.
Yeah, there's a certain like part of me that can't actually understand the TSM price action, but in terms of like owning a dependable stock with growth and expansion in all the right areas and complete moat, almost monopoly of its particular industry, I don't think there's a better stock out there. I don't think there's a better company out there right now. I mean, one is like the execution of its competition has been so poor that it's positioned the company so well. But look, you know, Nvidia, AMD, Broadcom, Qualcomm. You know, you go down the list, all the custom chips that are being made, Google, TPU, Amazon, you know, so many of them, if not all, are being, you know, fabbed by TSMC. And so right now they completely control price. They completely control supply. Basically, every wafer, they have complete control on pricing. The large swath of packaging they have, you know, so they're just in such a remarkably good position that's why it's hard to think of any other name that would sit above it on our AI 15. The only reason like it doesn't, you know, at times or Shay that could knock it off its pedestal is just the fact that it doesn't have alpha. It doesn't have the same amount of alpha. Like, you know, for how well it performs, the stock doesn't necessarily run the way other names do.
Well, do you think it's because of opportunity cost? Because in my initial read, I was like, all right, well, what is the headwinds I read through that report? Because there was so few. If I had to pick a hole, it was the FX pressure and margin dilution from their overseas fabs, which again is a short-term headwind if I had to choose any. Long-term, it reiterates their dominance. Do you think it's like more of an opportunity cost where you're seeing these names in the space just like go up so much every single week that the appetite isn't in a mature monopoly like TSM?
Well, I mean, it's you know, just verifying. It's up like 37% per year. So like in terms of like it's beating the S&P by a long shot. I just think, the comparisons to the growth of a Robinhood or even the recent upturn of an AMD or, the since Liberation Day version of Nvidia, there's just kind of that, where people are like, if I can put a dollar to work, where do I put that dollar to work? There's certainly the regulatory issue. There's certainly the China risk. There's certainly the amount of capex that they're going to have to spend to expand capacity into the United States. But I just don't see the secular going away. And I don't have any evidence yet that the competition can meaningfully disrupt its business. So those two reasons, like, I'll stick with it. But if you're looking for a higher alpha, it may not be the name. It may be a bit more mature. But we see the same thing with like Google. Like I like Google a lot, but like right now, when you put a dollar to work, if it's owning Google or owning TSM or owning an Nvidia or owning an AMD or owning a Robinhood, it is kind of hard, despite the fact that these are very different. If you are looking for explosive upside, some of these companies just don't trade that way. And so there's a, that's always a factor. But over time, I think what you and I would agree about is good companies the price discovery tends to work out over time. So like right now where you're getting, and you're going to want to talk rockets at some point, but all the stuff going on with ASTS and Rocket Lab, and like, look, the person that's buying TSMC as a large swath of their portfolio or buying a large amount of Google or Amazon or a dividend stock like Apple is probably going to, if they have a percentage of their portfolio that might be for like a Rocket Lab, it's like almost like crypto. Those kinds of companies. It's like, yeah, it's got a ton of upside and it could totally explode, but they're not making a lot of money or any, they're a much riskier bet. The utility is not as well understood, scale, disruption. So you got to kind of also think about that. Like you're a growth guy. I'm a growth guy. So we're comparing growth sometimes to things that like, hey, if I'm a regular investor, I'm staying in Apple. They have 2.4 billion or so handsets out there that people can't get rid of easily. And they pay a dividend and they buy back their shares. And by the way, now they're on sale a little bit after some of this AI fodder. So maybe so it's always a opportunity cost.
Yeah, I mean, I will say ever since our relationship, like I have adjusted my mentality on specific winners. Like we're going on rock. Let's talk about space right now because how can you not after seeing the week it's had, and also caveat though, like it's still nuts to see Rock Lab being a $25 billion company and ASTS a $20 billion company. I'm not selling any shares. I'm adopting your mentality of don't sell the winners. Let them compound. Even though they are both overextended, guys. Like I'm telling you, it's overextended. Like today, I don't know. I saw Rock Lab down 5%. Maybe it's a little down 2%. ASTS down 3%. I think it needs to have a near-term pullback. That's fine. But I'm not trimming. And I think maybe because I've been a Palantir shareholder for years and I trimmed half when it was at $30 on my position. I de-risked it because I got under $10. Like, all right, tripled it. I'll de-risk my initial capital and now let it compound from there. I think Rock Lab, to me, I'm treating them, Rock Lab and ASTS, as like the Palantir of the space. Not because they do the same thing. They don't. I'm not saying don't call them the Palantir of space. But portfolio management style, I'm treating it as such because they occupy the same strategic posture. It's an embedded systems level player that benefits from a secular tailwind with no clear end in sight. I think AI is going to be an indefinite demand curve. That's why we're so bullish on TSM as the AI factory. There's going to be endless amount of demand. Even if the CapEx cycle plateaus, the demand is going to be some new derivative in that space. AI is here permanently and will only compound. So like for Palantir, for example, it was the rise of the machines, like the machine speed decision infrastructure where all these LLMs raced. In order to make these LLMs work, they need a decision engine. And Palantir is the only way to make those LLMs into the real world. That's why you're seeing these private markets, like OpenAI's 350 bill, XAI 200 bill, Anthropic 100 bill. Palantir is the only way to make these LLMs actually insightful and useful in the real world. Why not value them at 350 bill? It's ridiculous. Fundamentally, it's wow. But I kind of get it if these companies in private markets are getting these kind of valuations with far worse fundamentals because they don't have the 40% operating margins that Palantir has. So either way, going back to space, I just think for a $1.8 trillion space economy in the next 15 years, these are the early disruptors. These are the ones that are building the infrastructure in place this early for that industry that's only going to compound due to that indefinite demand that's only going to accelerate. And that demand curve for space logistics and on the defense front was underpriced before this year. And I think now it's getting more reflected into that with the Golden Dome conversation. So I think, go on.
No, I'd say the interesting thing about some of these like space and quantum is that it's just, you're always sort of trading against like very realized, immediate, recognizable businesses that create cash flow and profits. And then you're betting the future. Like, I was talking about this like the other day with Tesla. Like Tesla gets priced for a whole lot of things that it doesn't make a whole lot of money on yet. And if it was just a car company, we know it wouldn't be priced anywhere near where it's priced. But having said that, like people definitely want to bet the future. They want to bet it with autonomy. It's less obvious whether it's going to pan out, but I think the collective group that can kind of make picking winners and losers, and then that plus momentum kind of creates these incredible results. The interesting thing you said about, Palantir is, well, I don't necessarily agree that they're the only company that can make use out of all of this AI stuff. I think the bottom line is they've certainly proven that they are the company at this point. They are the chosen winner by a combination of retail and institutions to solve a problem that there hasn't been another obvious winner of at this point. Meaning none of the first era enterprise software companies have been picked to basically solve this problem. So all the inflows are going to Palantir, which drives it higher and higher and higher in the expectation that it's going to do something in the future, just like the expectation that we might need to move to Mars, or we might need to set more satellites into space, or we might be able to break RSA cryptography with a quantum machine, which could break Bitcoin. So maybe I should be invested in quantum now, knowing that that could happen in 2 years or that could happen in 10 years. We don't know. But what we don't want to do is miss it.
No, I mean, the risk of missing it is far greater than the risk of maybe it's pricey on traditional metrics, because this is the first time in history that we've experienced multiple super cycles happening at the same time: AI, quantum, space, except electrification. So I think it's the risk on appetite makes sense to me, because there's never been a better time for disruptors to really compound at this state, at early stage in their maturity. But I also want to go back towards Google, because I think Google's a name that's finally catching some momentum this week. I think it's 185 last time I checked, 190 maybe. This is one name that you and I both agree on, that people are falling in love with the narrative of AI is disrupting them far too easily. It's very sheep-like mentality where if you know the company itself, it's not really cannibalizing at the pace people expect. Everyone's like, oh, I use ChatGPT half the time or even more than half the time than I use Google now. Fine. But I do believe that Google's future is going to be more of, it's not going to be price per click, how they print money in search. It's going to be kind of price per token, for example, because the Gemini is such a connectivity layer across all their workspace products that people are not going to give away Google Docs, Gmail, etc. Like, they're going to essentially have such high quality data they can monetize via tokenization or tokens. What's your take on Google finally catching a bid? And do you think when is that narrative finally going to expire potentially on AI is going to cannibalize them? Because I still don't see the bear FUD going away anytime soon. Oh, can you hear me, Daniel?
Sorry, I had a little connectivity glitch there, but I think I know what you asked me was about, about Google. First of all, so Google has a lot of different businesses. I think you shared a really good note in our Futurum Signal that kind of looked at how each part of the business breaks down, and then kind of how a number of the investments and the company's future is not appropriately valued. It's interesting in these larger companies how innovation doesn't always get valued. Google's doing things in quantum. Google's doing things in autonomy, or Alphabet is. They're doing things, in generative AI. And largely, they're still priced pretty efficiently for just their core businesses, which is mostly in advertising. Having said that, a profitable and growing cloud business, a generative platform that's being integrated on top of all of the existing search and software. And the idea of first movers versus, kind of laggards and Luddites is that most people are still using Google search. Now, we live in a little bubble where we know very tech people that are paying $200 a month and have subscriptions with OpenAI and subscriptions with Perplexity and subscriptions, and maybe they're not using Google. And so too often that becomes the FUD or becomes the data point that we use when we think that the market is eroding. It's not eroding. Now, what is happening, of course, is Alphabet and Google, it took them time to basically build a plan. They've got this situation. They are in this kind of Kodak moment. The Kodak moment is right now advertising and search is film. Okay. It's become for more than a decade, almost 2 decades now, maybe even a little bit more, actually, their main revenue source. And they've had a big sticky moat. Same time, it's very obvious that generative search is going to replace traditional search, which changes the entire economics of the business. Paying for clicks, like you said, it's going to probably be something that agents do, tokens do, but the ability to actually offer the service and add generative value into search, by the way, right now for free, if you use Google search, you get access to it for free, is already giving people the value that others are asking you to sort of pay for. And at the same time, if any company has those sort of the moat to be able to transition people and then transition revenue streams, they certainly are in a good position to do so. And the other thing is, by the way, is search numbers as we know them haven't actually gone down. There was like 1 month that search utilization went down a little bit, and the whole world panicked. Pulled the ripcord. It's over. Google's done. Google's toast. They're smoked. And then the bottom line is actually search numbers have started to rise again. And so the economics of the whole thing just don't actually play out. But I just really like the business. I just think their demise has been overblown. I think the price has been somewhat stuck in the mud. They've got a lot of regulatory risk. That regulatory risk still exists for them. And I think it's being priced that way. But at the same time, like, it's just not a company I'd bet against.
Well, can you talk? I think one of the main reasons why Google is going to has an advantage is because, again, TPUs, I think owning your own hardware is a must in the future. Also, distribution. Model quality matters a lot on the distribution ability that they have in their vertical stack. So, like, do you believe that Gemini's model quality will only improve at a pace that others can't really match due to that distribution angle that Google has via all their suite of products in the workspace?
Well, they certainly have a lot of real-time data. The fire hose, utilization, what people are doing, interest, demographic data, locational data, needs model and optimization. They have a subset of enterprise data. They have endless resources. They have by the way, they had a fairly significant research team well before it was popular to overspend on hiring researchers. They bought Brain, they bought DeepMind. They've been building that team out for some time. They bought and built the infrastructure. So TPU, multiple generations. They're a little late on CPU, but like I said, I think that was an easier problem to solve if you understand how infrastructure and IP is out there. But yeah, I mean, look, they have all the parts and the pieces, and they of course can tie together the cloud business and tie together the search business, the ads business, the autonomy business, the physical AI business. I mean, they just have all the pieces, Shay, to tie together to do this. But yeah, I mean, you cannot undervalue the vertical integration, for instance. I mean, look, they're the one company out there right now that you could argue, outside of their cloud business, that could actually do everything really without Nvidia at all. They could. That they're not, but they could. I also think that's going to be a margin protector in the long run. That is the one risk that I see Nvidia has. And, I'm obviously very bullish on the company, but their amount of margin that they eat up and down their supply chain, because really all the revenue and all the money goes to them. So it's like you want to be in their ecosystem, but it's like everybody's basically panning, for gold. But a lot of the gold staying, the kind of Nvidia sitting at the top with the big pan, and the holes are small. And so what's falling through for everybody else is pretty small. So, and like I said, I do think there's some risk. Regulatory is one of the biggest for them. But I think that from a price standpoint, it's been artificially sort of held up for quite a long time. It hasn't returned a lot to its investors which again has probably had more people chasing some of these other growth names that we've been talking about.
I actually want to talk about Meta as well, because I think Meta made an interesting announcement this week on Alexander Wang, the head of their AI superintelligence team, maybe spread the rumor on open source, maybe no longer for Llama. They might make that pivot. Do you think, because right now, essentially Meta's buying off the shelf Nvidia chips. Do you think they're ever going to create, I know they can't on the flip of a switch. We've seen that with Microsoft. It takes multiple generations to create your own in-house silicon custom chip. But do you think Meta is going to go follow that path that the Microsoft is right now on, and what Google has done for TPUs, what Tesla's trying to do
They
for
are.
Dojo?
I mean, MTI is a thing. They're already working on it. They've been developing and building an inference chip. They've obviously spent a fortune, but are they going to do it the same way? Look, Meta at this point is not building a cloud for third-party enterprise consumption.
Why haven't they, by the way? It feels like it's a very synergistic initiative just to be that fourth hyperscaler.
It's a different business model. I think it's a different business model. I mean, I think that what they are democratizing in terms of some of their capabilities and services, I just think that that's not the best in their mind, right? They've got very smart people there that are doing the maths and the economics. Do they want to fight for VMs and CPU workloads and for enterprises to put their data in their cloud? Or they already have a business where everybody's giving them all their data for free. It's basically enabling them at huge profit margins to build out infrastructure to scale, to build products for their utilization. It's probably because they don't need to. And frankly, it's a hard business. Google proved it took some time, but it took Google a long time to actually stand up the infrastructure and get it to a profit level. Whereas, Meta can make the investment, build Llama, use licensing mechanisms to create margin and revenue, put all this big investment in AI into their products to lower cost, to optimize what customers see, to increase revenue per user. It's all about, it's again, this is a bit of a theme of the show, but it's opportunity cost. Like they're building out these data centers to drive high margin revenue to their core businesses rather than a very CapEx intensive business that, again, they'd have to even build out more capacity to support, because the capacity they're building is for their expectations of supporting their own products. So Amazon got it right because they were there early. I think Meta could do it. They certainly have the resources. It's probably just not the best way they can apply a dollar.
Gotcha. That makes sense to me. I hear that. And I think I kind of want to circle back to earnings season, because this feels like this week is the first week of this earnings cycle. And I think what we're seeing via TSM, what we're seeing via Netflix, it's going to be difficult to catch a bid after really strong reports. What's your kind of tell on how you think this earnings cycle will go with these major players? Even though the AI is still the main event, I think a lot of these stocks have gone bids leading up to these print that's causing a multiple expansion opportunity where people are saying, oh, that wasn't a good enough earnings to justify the prior move.
Let's use a different lens here and maybe say we're in a price justification quarter. We've had this incredible run up in names, right? And what we're betting on is a couple of macro factors. We're betting on interest rates stabilizing, maybe even coming down. We're betting on inflation not running away again, right? That the tariff thing, we're betting on, that companies are going to put growth to work with the one big beautiful bill, because we're going to have to outgrow inflation. Look, I don't think we're at 2.7. I don't think we were at 3.0 under Biden. I think we were at 30 and now we're at 10. I mean, inflation is real. Labor inflation is real. AI is deflationary. So we're looking for companies that are showing the prune to grow efficiency to run their companies into growth. CapEx intensity, I think, is put a little bit of a cap on some of these massive names. They're spending a ton of money, still not able to fully prove out how they're going to make money on all that investment. But I also think, like I said, sometimes I think you said it well about some of these names. It's like you do need rest periods. You need little healthy pullbacks on names. Like anything that goes up pervasively or persistently for 20 days, 30 days, these kind of runs. It's like if you're a reasonable investor, you have to expect at some point you're going to have probably a pretty decent sell-off day. It can't just go one way forever. These are either opportunities to accumulate, to buy. but it's also an opportunity for, like I said, these companies to grow into the multiples because, look, where did the S&P sit, right? In the low 20s, high teens. A lot of these names are trading in the 30s, high 20s, 30s. And they're not all growing necessarily earnings like an Nvidia, where they're actually seeing their forward earnings coming back, which is why I think Nvidia stayed so compelling, is because like if you compare its price to even a few years ago, it's forward earnings is coming down each quarter because they're just executing and delivering so consistently.
Well, I know some really smart people who entering this year like this is going to be the year where Nvidia's margins are going to erode. I'm like, I was always sticking to like the AI spend is just in the heart of it still. It's not going to peak right now. The year-over-year percentages might diminish, but the actual dollar amount is going to still be substantial for years and years to come. And Nvidia is the GPU engine of this whole new digital economy. Yes, AMD is going to find its subshare in that. And I actually want to talk about AMD because they are an interesting case study this earnings cycle where one of those, you said that going up 20 straight days, feels like ever since you communicated, what was it, a month ago after the AMD Advance events, that AMD is like, inference is going to be a major launching pad for them. I think it went up, what, $100 to like 160. It's like up 60%. So like, what do you like for an AMD, for example? Like, what do you think they're going to have to communicate in their earnings that's going to really justify them as that price justification you just called out for this cycle?
Well, can I say something? I'm going to say something about Nvidia first. Is like, first of all, this China news. We didn't really touch on it here, but like we talked a lot about it in other platforms. Like, was obviously really, really great news. The idea that their margin is going to get hit. What has to happen for that to happen is there has to be meaningful scale competition that can actually force pressure on the margin right now. And there just hasn't been a meaningful competition yet that can do everything that NVIDIA does, full stack. It's basically leading. And by the way, rack scale is really important here, is they make so much money on rack scale. Like, it's not just selling a chip, it's the fact that they sell the system, the networking, the cables, all this stuff together is creating these really, really strong margins. And there's so much FOMO, which is driving this CapEx infrastructure boom. How many gigawatt data centers were announced this week? Whose technology is going into most of them?
Sovereign AI is very real. 100%,
and sovereign is going to be massive. And so,
yeah.
So this is where that math we keep doing about $1 trillion, half a trillion to $1 trillion over the next 3 to 5 year period of time. And that, 10% to 25% goes custom. And then you start to back the math out of AMD. Look, this is a sort of a pivotal quarter because everybody's kind of betting AMD is going to do the inference thing, and that they're going to do it well. So far, they've obviously got some great walk-ons on stage. They had Sam, they've had Meta, they have Microsoft that are all supposedly using a lot of their inference chips. But at the same time, a few quarters back, they stopped reporting the Instinct number, which to me was like, oh my God, like right now in this moment, you're going to stop reporting your GPU growth number individually in the data center number. They had that around 5-6 billion number they kept talking about. It was like, I really think if this quarter there was an inflection, a demand growth, a bookings growth, like this is the moment for them for AMD, for Lisa Su to pull that out and say, our new number's 10 billion, our new number's 9 billion. Like, show that it's getting traction, because technologically this stuff is great. It's very competitive with NVIDIA. Now, again, rack scale with ZT Systems and everything they bought, like that's a little bit less proven, but like it's competitive on memory and the bandwidth throughput, which is really important for inference. And their roadmap is there. But like, are they getting the order book? Are they getting the demand? Is this converting? Because every quarter NVIDIA comes out and it's clear as day how much Blackwell they're selling. People can literally math it down to the chip. NVIDIA's, leading the pack. AMD needs to show that it's at least keeping up. So if NVIDIA is doubling, then that 5 billion from AMD should be 10. And that's how they're at least maintaining the market share, if they're not taking some of it. And I think they have an opportunity to. And if they can take enough market share, that's when that sort of pricing pressure you're talking about could come into play.
Well, I think it's also really important for people to realize the ball game, the training ball game versus the inference ball game is totally different. What people like, what the company is actually trying to accomplish in either arena, very different. Correct me if I'm wrong, Daniel, because you're much more experienced in this space. But like, I think training matters a lot more on quality. I think inference quality is still somewhat important, but really the quantity aspect of it is way more important. Where what's the alternative solution that's like maybe less quality, because you don't really need the high quality as much as you did in the training arena as you do in the inference arena, because of how much that's exploding due to train data becoming cheaper and cheaper. So I think like AMD, for example, like I wasn't quite bullish on AMD a year ago. I'm quite like I see the lane now, because they could not sit at the same table on the training front as the Nvidia, but on the inference front, I was like, they could, just because the quality of the chair doesn't matter as much.
Well, it also the software doesn't matter as much. The moat,
Totally.
like that's why like companies like I'm an investor in Grok, Grok Cloud now, the GROQ, and they have incredibly fast inference, and so they've done well in Middle East and Canada and other places, and you know they have an inference chip. That's all they do. But you're also seeing like where a lot of the hyperscalers are going to go first with their own infrastructure will be inference, and that will be a vehicle. Having said that, like, you know, anytime you've used a model and you get like that slow churning, you know, people aren't going to be happy with that. So just like search, just like bandwidth and connectivity and 5G and Wi-Fi, like people are going to want incredibly fast throughput. So, you know, this is where inference and throughput and speed and the infrastructure will matter. And so if you can get a query done on a, you know, a Copilot claim on Microsoft or a Meta, you know, you can do a generative search on social or an ad build using their inference tools, and it's lower cost per token per watt. That's where these companies have a chance to come in and play. Like AMD.
I mean, that makes sense to me. I mean, it really does make sense. I think that I don't know how much you know about Nebius, but I think for me specifically during the training data explosion a year ago or less than a year ago, I was like, I don't know about Nebius's software solution, but like, again, like you mentioned, inference software doesn't matter as much. Nebius is a really interesting EU sovereign play on the data center growth that they're going to have. Curious if you have any kind of color, if you don't, on Nebius.
Sorry, I fell asleep at the wheel. So look, I like Nebius's amortization model better. I like that they are being a little bit more, you know, they're taking a little less risk in how they're handling the GPUs on their books, you know, because you see how CoreWeave and Nebius, they're similar neo cloud businesses. I mean, look, these dedicated, built from the ground up AI clouds are super interesting. They've obviously run away on price a little bit. The business is all about basically, you know, they are really beholden in some ways to Nvidia. They're both have large parts of their cap table actually with Nvidia. They run all Nvidia. So as long as, you know, there's a need for more capacity and they're willing to continue to build it, my concerns with those businesses is just about the CapEx intensity. What's the differentiation between them? We're actually, I believe, going to be doing some work in our lab on some of this stuff to kind of understand more the differentiation, because I think that's what they're going to be really needing to do is prove that they're not just an infrastructure they're not just basically a rent and infrastructure play. They have
like not a
value.
broker,
Where does the value add come in to these companies? Why go with them over one of the big clouds? Why go with the one that you would select? What do they do differently to basically enable, you know, AI? Having said that, like I said, you know, Nebius has shown some fiscal durability, responsibility, and clearly they're building a fan base out there in retail.
No, I mean, I love the story. It's very mission oriented, and I think it's a name I'm definitely monitoring, especially this upcoming earnings cycle. And I want to talk about next week's earnings cycle. But before I do, I want to say we finally have a great announcement. Monday is going to be the launching of the website and platform Futurum Equities. It's finally in the making. It's going to be released. And yeah, well, we have the final meeting today. I think so. Let's see. But it's really important because the Futurum Daily Signal that a lot of you guys tune into, I see the numbers. I really appreciate it. It's great numbers that we love seeing on our end. You can reference all of those content now on the website, and you're going to see every morning's Futurum Daily Signal as well. And it's really important during earnings cycle because guess what got released this week's Futurum Daily Signals? What was it? It was ASML earnings reaction. It was TSM earnings reaction. It was why Apple should buy Perplexity. It's all it's really futuristic thoughts. It's not like, oh, it's repeating facts on this is what happened. It's all right. Well, TSM showed us this crumb. I think it's going to turn to this. Apple needs to do this in order to catch up with the AI race. It's all of like, what will it do, not what has it done. And that was one thing that Daniel and I were very adamant about Futurum Equities is we provide the air access insights research to investors, and that air will always showing what the signal is in the future. So I think that's what the signals have been. And I think that's that along with the AI Futurum AI 15 list, the Cyber 7, the Data Center 10 that's in the works, that's going to be released in a couple weeks. All of that will be on the platform. That will be easy to use. You don't have to check your email anymore. So yeah, anything you want to add
log
to that,
in,
Daniel?
you can come join us. You can get in your email. You can link off to it from Shay's X posts. We don't leave a lot to the imagination, but it's worth being part of our community for sure. Those things are great. And by the way, we'll be, I think you and I are going to be in the same physical place next week. So there may be some spottings of Dan and Shay. Dan and Shay.
The Dan and Shay, the band, not the band, not the band.
No, I like saying that though. Keep people wondering.
Listen, next week's episode might be an in-person one between Daniel and I. I think we're going to be in the same city for the whole week, so that'll be fun. What was I going to say? Oh, the reason I brought up the platform website is because a lot of next week's earnings is going to continue momentum. A lot of earning reactions will be next week. I kind of want to pick your brain a little, Daniel, on some names are reporting that see what your pre-earnings thoughts are. We kind of touched on Google a bit more, but maybe I want to, that was more futuristic where Google's going to become. What do you anticipate this earnings cycle to be primarily focused on? And what do you think the highlights will be from Satya?
Yeah, there's three main numbers I'm going to be looking for, and this isn't what every investor would look for, but one is I'm always watching cloud growth right now because I want to see if Google continues its momentum. It's been sort of the class of the three bigger clouds. Now Oracle's now come in and too, but they've been growing faster than Amazon or Microsoft pretty consistently for multiple quarters in a row now. AI consumption, meaning like how is AI making you money? Because that's the one part that like I'm looking more and more. I said this would be the year. I want to hear more. I think Meta's done this really well in talking about how they've kind of used AI, and that's why I think there's been so much enthusiasm for Meta. I think Alphabet, Google could do a little bit more to sort of make it clear how AI is sort of making money, and by the way, also cementing their search business, not disrupting or displacing it. So probably those two big things. And then I am looking for like commentary from CFOs this quarter about like, was there any drag from like things like tariffs? Like obviously we saw the big surplus last week in the budget for the month. Like it doesn't feel like the inflation. We didn't talk a lot of CPI, PPI on the show, but you probably talked about throughout the week. Like they were pretty uneventful. We've got possible Fed chair change, which is crazy. I mean, Trump can't actually make that happen himself, to be clear. But like, you got all these kind of macro things happening. But like, does any of this macro stuff matter? Like, I know that tariffs don't directly affect a company like Alphabet that much, but I want to hear like currency issues. The dollar's been devalued. Like, what are CFOs, CEOs saying in commentary about macro right now? Because like I said, it feels like everything's great. Market's super frothy. Inflation seems to be kind of tame. The bill is passed. Taxes are sort of in place. Crypto is ripping. Like everything feels good. But then again, some ways it just doesn't feel like it matches in the real world with real people, considering how small part of us are actually in the investor class. Like what's really going on out there? And I want to hear that from them, from all the CEOs next week. And I'll talk to CEOs next week. ServiceNow report. I'll definitely catch up with Bill McDermott at some point next week. IBM will report. I'll talk to their CFO or Arvind next week. So also some of the more traditional tech companies, enterprise tech companies too, which I'll be looking a lot more for kind of how's buyer demand in the enterprise, because consumer and AI have moved really quick, but the enterprise stuff's moved a lot slower.
Yeah, I mean, first off, before I continue, I know I said Satya, I meant Sundar. I always confuse the Google CEO and Microsoft CEO's name. On me, Sundar. I hope he becomes a showman a little this cycle. I think he needs to kind of bump up his game and sell a narrative. Obviously, don't be full Elon, but just a little taste of like what's search is evolving and how they're monetizing AI will do wonders. I'm so curious on ServiceNow because, like you mentioned, Bill is an incredible CEO, and they are. I treat ServiceNow as like the blue chip growth SaaS company. Like they always go first every cycle. they set the tone on how things are going on the enterprise software space. So as someone who's an investor in Snowflake, MongoDB, etc., like that's I want to see has the sentiment really bounced a bit on the business spending and enterprise software, because we're seeing it right now on the stage one of AI significantly, the hardware, servers, etc. Not as much on software as I thought we would anticipate, but maybe that changes the cycle. So that's one name I'm watching next week. Another one, let's see anything else. We got Tesla. I think Tesla's not even really an earnings story. I'm actually curious on your thoughts on Dojo. Do you think it's real as much as people think it is, or do you think because Dojo is a really big component of like that vertical integration that we love to talk about. Tesla is like kind of one of the major winners potentially on software and hardware for the physical AI theme, and Dojo is a big component of that. Do you have any additional color on what Dojo is on your end that you've
I mean, I think
seen?
it's very real. I think he's building sort of you like to say things like an operating system for physical AI and autonomy.
Mhm.
I mean, the amount of data he's pulling off from cars has been their biggest advantage over Waymo. We like to talk about how many rides Waymo has done, but you talk about how many Teslas are on the road, like how many Waymos are out there collecting data versus how many Teslas are out there every day collecting data. It's the same thing he's looking to do with Optimus. It's the same thing. Like it's all about, getting volume of next generation technologies out there that are basically experiencing and interacting with the world in which they're going to operate. So I do think it's very real. I think there's certainly work to be done. Like I said, I really struggle at times. Like Tesla, one day it's like this is a car company that's like trading at some ridiculous earnings, even as a tech company. And there's other days like you start to put it all together. You start to go, well, once he merges XAI, SpaceX, Boring Company, Tesla, Neuralink, and I know he may or may not ever do all that, but you start to put it together and be like, he's got this just complete technological stack to basically sense and experience everything in the physical world, which if we believe that's the next multi-trillion-dollar opportunity, he's just a little bit ahead of all this data center stuff. Like he's just kind of skipped ahead. He built his data center to sense the real world. But can he do it? Can he build the software? Can he build the models? Can they build the libraries for everything? Like they've clearly done it for cars, but can they do it for everything? Because that's, of course, like a lot of what, they're doing with Nvidia, Groot, and all the things they're doing to build basically models for robotics in the real world. But look, it's definitely on his roadmap. Time is always a question mark with that guy.
I know. That's the only variable in the calculus, in my opinion. That's why, who knows? Maybe it doesn't go anywhere for years, but I do think the inevitability of them building that neural network for mobility and robotics is going to be a thing. So we're at the top of the hour, guys. I know I stole away Daniel from an hour away from him on his vacation. I hope you guys enjoyed it. I enjoyed it a ton. Next week is going to be a fun earnings cycle. Daniel and I are going to meet together all week. We have actually something maybe exciting as well on Thursday that's in the works. Any final words, Daniel, before we hop off?
No, man, I'm excited to see you in New York next week. Excited to get the site launched on Monday. We're going to be rebalancing the AI 15 pretty soon because it's probably already been 6 to 8 weeks since we launched it. And every 3 months we promise there's definitely some new names out there that probably deserve a look and some attention, some names that are on it that might have fallen off the list. And we're going to keep everybody up with that. But no, appreciate the support. Love to keep getting your feedback on the show. Like, I know we're going to start adding some touches. We're going to take this thing on to Apple and Spotify. We're going to do this. We're going to next level this show. It's been amazing, the support, great viewership, great, engagement online. But tell us more how we make this thing better.
Yeah, I mean, this is only a 5th episode, and I'm looking at right now. I think it's all-time high, 11,000 views already right now. So love the support. Give us feedback. We want to improve, and we're about to put some lipstick on this podcast in the near term. So have a good weekend, everyone. Enjoy some Z's before the earnings week. See you next week.